Welcome once again. So this is the part 3 of our strategic case study analysis, and we are using May 2020 exam as an example. So let's dive right into it. Let's begin with the customer focus limited performance and position. So it says the development of supermarkets in Ghana over 30 years ago coincided with the growth of incomes and the increase in purchasing power. Even before we continue, I'd like to say that we've already done 2 sessions on this case analysis. This is not the beginning. There's session 1 and session 2 on this YouTube channel. So all you need to go is to search for it. It's called Analyzing a Strategic Case Study. And there's session 1 and session 2. Please do well to watch it to get an understanding of exactly how we are approaching this case study. And if you haven't subscribed to this YouTube channel, please do so as well. So here it says the development of supermarkets in Ghana 30 years ago coincided with the growth of incomes and increase in purchasing power. We've talked about this very, very much in prior sessions. It says international food retail chains launch branches in Ghana, such as ShopRite, which is South African owned, alongside the rapid development of homegrown stores and chains such as Maxmart. So what is this signaling here? International food retail chains. So companies from outside are seeing an opportunity in Ghana because of the rapid urbanization that is going on and launching businesses here in Ghana. They are launching businesses here in Ghana. So what is it implying? It's implying that there's an opportunity in the Ghanaian landscape. And also it's increasing competition. But what does it mean for the customer? It means that the customer has a wide range of, stores or retail stores, food retail stores to go to, So it's signaling that, there's opportunity here. But because of the influx of all these international food retail chains, what's going to happen is that it's going to drive a lot of competition. The building of new shopping malls across Accra and elsewhere altered the pattern of shopping and changed expectation about what was demanded from store retailers. So at the beginning of this case study, we talked about the building of new shopping malls, right? And we said that Customer Focus Limited themselves have, a mall or a store near one of the key malls in Accra. So it looks like Accra seems to be a hot spot in a hot area, and people are building malls across Accra. And this has altered the pattern of shopping and changed expectation about what was demanded from store retailers in terms of the range of products and the convenience. So 2 things that customers are keen on, right? Anytime you are looking at trying to understand your customer, you must look at what they want or what they need, and that should drive your product strategy. We've talked about product strategy extensively in our session. So that should drive your product strategy in terms of, the range of products you'll be offering, and as well as, even how you offer them, at what times you offer them. So customers want stores where they can have access to a range of products. So it's like a one-stop shop. Once you enter, you can get literally everything you want because they want convenience, right? So they do not want to buy bread in one store and go and buy sugar in another store. That wastes their time. And so they are demanding range of products. And so this should drive your product strategy. That Customer Focus Limited as a business should be able to stock a range of products that customers would demand based on the information they have on them, and their anticipated consumptions. That is very, very key. So as well as the convenience, Customer Focus Limited should also focus on convenience, and we've talked about that on ways they can enhance convenience. For example, one key aspect of Qual's positioning market is to make available a diversity of products. So when we talk about strategic positioning, here it's talking about Qual's positioning, right? Qual is a competitor. It's talking about their strategic positioning. So strategic positioning is how you are positioned or how you are situated in relation to your competitors, right? And this is the way Kuala has positioned themselves, is to make available a diversity of products. Why? Because they know that customers want a one-stop shop where they can buy everything. So they've provided a range of products such that when you enter there, you get everything you want and you walk out. That's very, very important. And this is something that Customer Focus Limited themselves can learn from, right? Because once they enter your shop and they don't get everything, and they have to go to another store, there's the likelihood that they might not come the next time or might find a place where they can get everything. There are other examples concerning different commercial approaches to food retail, such as substantial online presence. For example, Malcolm. So we talked about the fact that technology is driving the way the food retail space operates, and that having an online presence is important. Very, very important, because customers should be able to go online, sit in their comfort of their homes or anywhere they are, and be able to visit your website, understand the products you have. And Malcolm is doing that to the very larger hypermarket. A hypermarket is simply a very, very big supermarket, very, very big supermarket. The word hyper means like extremely big, run by Palace Hypermarket. So in this context, so what are we saying here? See, this paragraph tells us about some competitors that Customer Focus Limited has, and is looking at some of the key competitors that Customer Focus Limited has and how they position themselves in the market. What makes them, outsmart their peers? So for Kuala, it was making available a diversity of products. For Melcom, it was their online presence, and for as well as things like convenience and other things. So these are things that Customer Focus Limited needs to take note of, because once you do your competitor analysis, you see the things that they are good at and try to deploy that as well, so that they do not outperform you in that area. That's very, very important. Very, very key. Now let's move on to the next paragraph. Let's move on to the next paragraph. The next paragraph talks about, it says, in this context, Customer Focus Limited began trading on 1st January 2017. It says in this context. So what context are they talking about? What context are they talking about? This context is basically referring to the previous paragraph, which is telling us about, the competitors that Customer Focus Limited is dealing with, from international food retail chains, from Kuala to Malcolm to Palace Hypermarket. These are big giants already in the space, and Customer Focus Limited is also coming into the space. So it's telling us that Customer Focus Limited is coming into an area that faces a lot of competition, So let's move on to the next paragraph. So that's what we mean by in this context. In the context of the existing competitive landscape, Customer Focus Limited began trading on 1st January 2017. So remember, we talked about the fact that the timing is important when you enter the market, right? So they entered the market when there were existing food retail chains, some from even outside the country. Initial capital was created with 100,000 ordinary shares, and the share capital amounted to 300,000. So they started with 100,000 shares, and share capital amounted to 300,000. The shares were owned in proportions. Bakpama was 70%, Akwesi Boateng was 20%, and Meriakwa was 10%. So Bakpo has, a huge portion or a huge stake in the business. Mary has the smaller stake. So we do not know yet, but probably this means that Bakpo has a lot more voice when it comes to making decisions. Then it says debt capital was also introduced. Customer Focus Limited raised loan finance of 100,000 100,000, which was repayable in full after 5 years unless renewed, subject to negotiation. So here we would want to know the interest rate on this loan and whether this loan and the term of the loan, which I already told, and how this loan impacts the P&L. Very, very important. So we are told of the capital structure, which is 100,000 right here, and 100,000 in debt and 300,000 in shares. Gives you a total of 400,000. The loan carried a variable interest charge. So this is quite interesting. So what does it mean by a variable interest charge? It means that the interest charge fluctuates depending on the existing economic conditions. So the interest charge is not fixed. And so this could have an impact, right? It means that the interest charge could go up. And if it goes up, it affects Customer Focus Limited. This is very, very important to understand because you would like to see the impact of this variable interest charge on the financial statements of Customer Focus Limited. And this interest charge was reviewed on the anniversary of taking out the loan. So it was reviewed every time. The loan carried a range of covenants associated with it, and these are detailed below. So covenants are basically restrictions, or they set, because you went for a loan from the bank, they give you some covenants or some rules or some restrictions to follow. And this can affect, how you do your business. So we would want to understand what kinds of covenants come with the loan. So anytime you see debt capital, one of the things you should think about is what's interest, which is I, interest rate, IR. And number 2 is what, which we just mentioned is covenants, which is C, covenants. Very, very important. Very, very important. Always think about that because covenants place restrictions, Just like if Ghana goes for a loan with an international agency, there are some restrictions, and these are covenants. You need that as part of to be able to have a loan. Yeah. Customer Focus Limited lease premises in Ghana, in Accra, sorry. The lease agreements require the company to pay a rental at the start of each year. And the high expense of the agreement reflected the store's proximity, you see. So rental expense too is high. Rent is high. And you need to understand how all of this will affect the financials. Rent is very, very high. And it runs for 5 years. So we need to do an analysis and understand whether it will be beneficial for Customer Focus Limited to actually renew. Because if you have rent, which is eating your P&L, and interest rate, which is also eating your P&L and your financial statements, is it reasonable to continue going on? Are there strategies we can deploy to pay off our loan faster? All these things, or find a cheaper place, or resume to things like online, having an online presence where people can order online. And so you didn't have to depend so much on the space. These are things that Customer Focus Limited should be thinking about. Now let's move on to the next paragraph. It says the lease unit was sufficient for Customer Focus Limited to offer a range of goods to attract high-spending customers who prioritize convenience over price. All the initial funding was spent on creating product lines in sufficient quantity to attract these customers. So what are we saying here? We are saying that Customer Focus Limited went for a lease space or a leased unit that could help them stock a range of goods, which is a good thing, right? In order to attract these customers. Additionally, the store units require substantial amounts to be spent on refitting and purchasing of refrigeration units. Very, very key. Aside the fact that they are also renting, when they moved in, before they moved in, they had to spend amounts on refitting the place and purchasing refrigeration units and cash desks that were capable of maintaining inventory records and of using loyalty cards. So all of this is expenditure, expenditure on refitting and expenditure on purchasing of refrigeration units. All of this is expenditure. So all of this is money going to, capital, money going to improving the units, improving the unit and making it better so that they can stock a range of products. Very, very important. So you see the amount of money that is going into, the lease premises. I'm curious to see how their financial statements looks like. So rent, lease, very, very important. Rent. So two issues happening here, which is number one, rental expense and interest rates. Very, very important. These are two things that we need to understand. Okay, so let's move on to the next. I hope you are getting the picture. So it says here that the owners forecast profitability, right? The owners forecast profitability from the onset and had initially carried out an investment appraisal that indicated that the store would make money over a 5-year period. So anytime you see forecast, one of the things you should note is that what are the forecast assumptions? What are the forecast assumptions? And have they changed? Because circumstances are constantly changing in the external environment, right? So you want to understand, what are the forecast assumptions? Do they still make sense? And based on the forecast assumptions, are we still going to make money? Do we need to tweak or change the forecast assumptions? Because this forecast profitability was from the onset. Things might have changed. And so we want to understand, do we need to make some changes to the forecast? It also says that there was an expectation that the business will continue after the 5-year period, but only after a substantial appraisal was undertaken shortly before that time about whether the business was likely to be viable in the longer term. So you see, here they are talking about just give me a second to underline this. The viability of the business, right? Whether the business will be viable in the long term. One of the things that Customer Focus Limited should have done as well was to, constantly monitor the progress of their business compared to the forecast, right? So constantly monitor the progress of their business compared to the forecast. This is very, very important. Compared to the forecast. Very, very key. Very, very key. So after the 5-year period, what they go through is a substantial appraisal to assess whether the business is actually viable in the long term. So as discussion are taking place at the beginning concerning how the owners would exit the business should they wish to dispose of their investments in 5 years. The owners agreed that they will not take any dividends out of the business. So what does this mean, that they will not take any dividends out of the business? It means that these dividends will be reinvested back into the business. to be reinvested back into the business, which is a good thing, right? Which is a good thing, because once you are reinvesting capital into the business, that should help your business actually grow a lot more. And this is capital that you do not have to get from a bank, and so you do not have to pay interest. This is dividends that they put back in the business or plow back into the business, so that basically it helps the business to grow. Very, very important. Very, very important. But discussions have gone on between the owners about how, there's a possibility of them exiting the business after 5 years, if based on their appraisal, if they want to dispose of their investments. That's also a possibility. So that's very, very important. That's very, very important. Very, very key. So now let's move on to something I would like to talk about, which is the loan documentation, right? The loan documentation. Customer Focus Limited has gone in for a loan, right? And so we would want to understand what is going on with this loan. So the loan amount is 100,000. The interest rate is a standard variable rate. So it's variable, it could change. It could change. So that's one of the things you should know. If it's a variable rate, it could change. Then it's repayable in full, which is by 31st December 2021. Don't forget that they started their business when? In 1st January 2017. So 2017, 18, 19, 20, 21. That's 5 years. So from 1st January 2017 to 31st December 2021. Fixed charges on personal property of signatories. So in case something goes wrong, the security is the personal property of the signatories. What are the conditions? Customer Focus Limited agrees to meet the following as a condition of the loan. Number one, now understand these loan conditions and how they are going to affect the business. Understand these loan conditions. Number one, repayment interest rates, repayment schedules, and final date of repayment can be altered by Accra Business Bank, if covenants are not met. So if covenants are not met, the interest rates could go up, the repayment schedule, and the final date of repayment. These are stringent conditions. These are very, very tight conditions. And I wonder how Customer Focus Limited is going to, handle these conditions. Number two is Customer Focus Limited agrees to maintain the following covenants. So let's look at these covenants. Covenants are always important. To maintain monthly cash balances sufficient to pay the following month's interest payments. So there's a minimum cash balance that Customer Focus Limited has to maintain. Don't forget that they also have rent to pay. So I'm wondering if at some point in the future they will become cash trapped, or they won't have liquidity issues. If they have liquidity issues, it's going to be a huge problem, especially when they have to reserve some amount of money, a minimum cash balance that is sufficient to pay the following month's interest payment. So cash flow management is key here. Cash flow management is key here. And so, their cash, I'm just hoping that their cash position it's managed properly, because things might get tight. It seems that there's a lot of restriction when it comes to cash, and you use cash for a lot of things in your business. So that's something we'd want to look into. To maintain net working capital always at a positive amount, defined as inventories plus receivables minus payables. So this position, this working capital position must always be positive, And what will make it positive? If payables are greater than the sum of inventories and receivables, that would make it negative, So even in terms of your procurement, even in terms of how much you can owe other people, because that's payables, money you have to pay other people, it must always be on the low. It must always be on the low. So your payable position must always be on the low. If it goes high, you are going to get into a negative working capital position, and the bank doesn't allow that, and the bank doesn't allow it. So you can't have buy way too much things on credit. If your the amount of stuff you buy on credit exceeds your inventory plus your receivables, you've gotten into a negative working capital position, and that would be a problem. This next one is that let's see the next one. The next one is that it's getting interesting. To maintain gearing at no higher than 50%. So gearing is defined as debt over debt plus equity. So gearing is the amount of debt in your capital structure. So it shouldn't be higher than 50%. It shouldn't be higher than 50%. It shouldn't be higher than 50%. We are told that debt is 100K, right? And equity is 300K, which is a total of 400,000. So at the moment, gearing is equal to 100K over 400K, which is equal to 25%. So at the moment, they are meeting that, but gearing should not exceed 50%. So you can't even, once you are borrowing more and more, for example, if they borrow an additional 100,000, that might increase their gearing ratio. So they should basically be wary in borrowing more. So these are some things that they should certainly be looking at. Very, very important stuff. Very, very important stuff. So this is where we would end today's session. And I hope you enjoyed this session. If you haven't subscribed to this channel, please do so. Click the red subscribe button there so that anytime I post a video, you would be the first to get it. We'll be moving on to the next thing where we'll be looking at the financials as well. And then I hope you enjoyed this lecture. This is, I think, the third session. We'll be moving on to the fourth. Thank you for watching. Have a good day.